Hi value investors, welcome to my channel Value Investing Apply. Today I'm gonna make an extension of Apple's case part 2 in which I will explain a little bit more about the repurchases and the splits and how both policies have been useful for Apple to deliver long-term capital appreciation. You will discover in this video that Apple is using this kind of policy in a completely different way with respect to its other US big tech counterparts. So you will discover in this video that there are drivers that are pushing the long-term capital appreciation of Apple are completely different from its big tech counterparts. I'm talking about companies like Microsoft, Amazon, Alphabet, Facebook, and so forth. So here, the first thing that we need to understand is how the repurchases really work. I could give you an example. For example, if you and a couple of your friends decide to start a small business which turned out to be really profitable in the middle term, and one of your friends decides to leave, so your friend wants to sell its part to you, to the company, and you and your other partner agree to buy that participation with the cash of the business. In that way, if you had previously, before your friend leaving, you had all of you had something like 33.33% of participation. Now, when your friend is leaving the company, you will increase your participation to 50%, which means that you will have the right to claim 50% now of the total dividends of the company. The same thing could be applied when a company like Apple is making these kind of repurchases, reducing the outstanding number of shares, and you as a shareholder, if you are not selling any share and you are committed to the long term, you are increasing your participation without the necessity for you to buy more new shares to increase your participation. So this is a really an interesting work that the company is making for you for your own benefit. Now, another important point in order to discover what are the benefits of making repurchases here is the fact that, when the company like Apple decides to allocate a certain amount of money for dividend payments each year, if the company is reducing the outstanding number of shares, it means that the company is paying more dividends per share. So that is another source of value for you as a shareholder. Another important point is what happens if a company like Apple decides to make more dividend payments instead of making or reducing the amount of allocated for repurchases. Well, you will receive more dividend payments, which could be seen as something really good, but you will have to pay more taxes between 15% and 90% of the total dividends received as an income. So that's something that really destroys your profitability in the long term. But instead, what happens if a company like Apple is deciding to allocate more money of its cash earned each year to make repurchases instead? It means that you as a shareholder will experience higher long-term capital appreciation, and if you don't sell any share, you won't have to pay any taxes for several years, which means that your money is really compounding here, okay? So this is something really interesting to know. And in order to complete the picture of the repurchases, imagine you have these earnings per share. The earnings per share is the net income divided by the total outstanding shares. If the company is making these repurchases, is reducing the outstanding number of shares, and in that way your earnings per share are increasing. And if the earnings per share are increasing, multiplied by a multiple, which could be the price to earnings ratio average for the company, is really you are pushing up your price or your target price for the company in the stock market. So this is really interesting to know how these kind of policies really are made to benefit long-term holders. Now, in order to complete a little bit more about the repurchases policy, I will show to you this kind of information here. If you remember our last video, we reached this. We calculated the intrinsic value per share for Apple of $202 per share. And well, if you want to see more of the details about all this calculation, you can watch the Apple's case part 1 in my channel here. Okay, so if you remember that, we will consider that this is just these two numbers are the present value of the cash flow generated by the current products, including their respective catalyzers, and then we were including the possibility of the launching in 2023 of the augmented reality and virtual reality products for the metaverse. If you remember that, if we remove that, our intrinsic value per share could drop to $144 per share. But given the fact that we trust so much in the management of Tim Cook, I'm sure that he will launch these kind of products in the next year. And then I just made certain assumptions from some Seeking Alpha assessments about the possibility of launching these new products for the metaverse, and we calculate this, what could be the potential free cash flow for the future, and we just take the present value of all these free cash flow for the future, and we just included this potential value of the augmented reality and virtual reality products for the metaverse in our calculation of the intrinsic value here. And well, we have these $202 per share. Of course, if you want to see more about these assumptions, you can just watch our Apple's case part 1 in this channel. Okay, now if we assume that this is a company with an intrinsic value of 3.4 trillion, we could analyze how the repurchases could influence in the intrinsic value per share of the company. Now, look at this. We have the outstanding number of shares here in 2020 and 2021, with the repurchases of 3.7% respect to the 2020. Now, if we just make projections, assuming that the company will repurchase in each year 3.7%. Year by year, which means that the outstanding number of shares are being reduced by 3.7% each year, and if we assume that the intrinsic value will be maintained for the next 8 years, which is something, of course, really conservative, because we know that there are other drivers that are pushing the intrinsic value. But in the end, for the purpose of this scenario, we will consider that Apple will maintain this 3.4 trillion for the next 8 years. But given under those conditions, you will see how the intrinsic value is increasing just because of the reduction of the outstanding number of shares. This is really interesting because, well, we know that this is a really pretty conservative velocity of repurchases. Here we have, for example, that before the split in the year 2020, we had something like from the year 2013 to the year 2019, we had a velocity of repurchases between 4.5% and 7%. So if we consider, of course, that kind of velocity of repurchases here, we will, of course, reduce the number of outstanding shares in a stronger way, which could be a higher push to the intrinsic value per share for the long term. Okay, now probably you're asking yourself why I'm talking about the repurchases, because, well, there are other companies like that are using the same policy. So you will understand a little bit more about this when I present to you this spreadsheet here. Look at this. In the case of Apple, Microsoft, Facebook, Alphabet, Amazon, here Apple, we have all this data from the repurchases and free cash flow, and I gather all this information from the SEC documents, the 10K annual report, and then, well, I was really curious about the fact that how much these repurchases represent from the free cash flow, because it is the free cash flow the source for the long-term value of the companies, because from the free cash flow the companies use all that money from the free cash flow to make acquisitions, to expand their operations, to pay dividends, to make repurchases, and so forth. So that I was really interested, and I was amazed how much a company like Apple allocate or use from its money, from its free cash flow, use to to make repurchases, 80.12% to make repurchases, to reward directly its shareholders. Look at the case of Microsoft, Facebook, Amazon and Alphabet, 43% Microsoft, only 28% in the case of Facebook, in the case of Alphabet 29.4%, and in the case of Amazon, well, I didn't see any sort of repurchases in its financial statements. So that means that the Apple is more committed to reward directly its shareholders. But that doesn't mean that companies like Microsoft or Alphabet are not committed to their shareholders. It is just that their respective business model required to use the rest of the money to reinforce its business model in other endeavors, in other new projects, in upgrade in upgrade its current products, or launch new products for the future in order to reinforce its business model for the future in the long term, and being able to deliver a double-digit growth in sales and being profitable as well. But look at this. The fact that the company is using, in the case of Apple, is using a great part of its free cash flow in repurchases, it doesn't mean that the company is not reinvesting an important part of its resources to be reinforced, to be really to stay ahead of its competition, to be innovative. In the case of Apple is already strong compared to its other competitors within its own industry. So we can see a little bit more about that when we compare the R&D expenses respect to the gross margin the last 5 years. Look at this. In the case of Apple just needed to take from its gross margin 15.20% in average in R&D expenses. R&D expenses, of course, are the source to innovate, to upgrade the current products, to launch new products, and so forth. And look at this in the case of Microsoft, Facebook, Amazon, and Alphabet. All of them need to take more of their respective gross margin to invest more in R&D expenses. Probably it is because in the case of Microsoft or Alphabet and Facebook, they are using the money to reinvest in other businesses that are not, or other projects that are not receiving revenues, or they are not receiving cash flows. And of course, because they want to be reinforced, they want to be sustainable for the long term and so forth. Apparently, their business model requires more resources to remain strong in the long term. That's not the case of Apple. Apple has, the moat and the competitive advantage in the case of Apple is based more in the name. So apparently the company has, the loyalty of the customers, which is amazing, because whenever the company is upgrading or launching new products and set higher prices, its customers are willing to pay for all those products. And that's something really unparalleled here. And look at the business model. The business model of Apple really does not require a 20% or 24% to spend in R&D expenses with respect to the gross margin. And despite that fact, the company remained really strong in its business model, remained strong in its own industry, and it's well prepared to take advantage of future catalyzers, that, like in the case of the 5G network, or the fact that the company has been able to design its own chips for the different devices, like in the case of the iPad, the iMac, and so forth. So really, the company is well prepared to continuously taking the lead in its own market, and that the company doesn't need to take 20% or 24% of its gross margin. That's why I would say that the drivers are completely different. In the case of Microsoft, Facebook, Alphabet, Amazon, all of them are committed to deliver double-digit growth in sales. But in the case of Apple, is another kind of company. It's not an online company. It's a company that offers, a giant company that offers physical products. So it's really unfeasible to deliver double-digit growth for the long term. So the company has found another way to deliver value to the shareholders, and that's why probably most bearish analysts do not understand what are the real drivers of a company like Apple. So here we have a strong business model that doesn't need so much resources compared to its competitors to remain stronger, to remain the leader in its respective market, and to have a strong business model that is well prepared for the future. Okay. Now we can make a certain compliments here respect to the splits, because Apple has not only applied these kind of repurchases by its own, but also the company has combined this policy with the splits over the years. You know what? When the company is making a split, if you, for example, has one share, and Apple decides to make a 4-to-1 split, it means that you will receive as a shareholder 3 additional shares. But of course, the worth of the 4 shares are equal to the share that you had before the split. So really, it is not a value creation policy. It is just an opportunity that the company is making for to make its shares more affordable to smaller retailer investors. Probably this is not really a value creation policy, but of course it's sending a message that the company is really shareholder oriented, and a message that the company really wants to share its profits with the smaller retailer investors, and the market really value these kind of things in the end. Okay, so look at this in the case of the Apple stock splits. The company started in 1987. And look at the space between the first and the second and the third. In the case here, there is a space of 13 years. Here 5 years. Here there is 9 years, and then 6 years. You can predict that this is a policy that Apple will continuously use in the future as part of its strategy, as part of its long-term strategy to reward its shareholders and give the opportunity to other smaller retail investors. Now, in the case of Microsoft started this split in the same year as Apple. But look at when was the last time Microsoft applied this kind of policies, in the year 2003. So apparently this is not a part of its strategy anymore. It is. I won't expect that Microsoft will apply this kind of policy in the foreseeable future anyway. The same thing happened with Amazon. Amazon, the last time of applying this kind of split policies was in the 1999. So apparently the company will not apply in the foreseeable future these kind of policies to give the opportunity to other smaller retailer investors. So this is really interesting, and something that I want to share with you just to end with this video is the fact that I found this website which is Counterpoint Research, and I found this data from the first quarter in 2019 and the second quarter in 2021. And look at this. We can compare here. We can see how Apple is compared to its other competitors in the handset industry, and it is not surprised that in the case of the shipment shares, Samsung has taken the lead over all these periods. But despite the fact that Samsung has taken the lead in the shipment share, look at this, who is taking the lead in revenues, and most importantly, look at this, who is taking the lead in operating profits. Okay, Apple concentrates on something like 40% of total revenues of the entire industry in this industry, the handset industry. And look at, in the case of operating profits, more than 70% are concentrated in Apple. This reveal that Apple really doesn't need so much resources to keep its business model stronger than its competitors. And that's why the drivers of this company are completely different if we compare Apple with the other companies like Microsoft, Facebook, Alphabet, and so on. So here, this is of course the amazing business model that relies basically on the loyalty of their customers, and of course the company respond to taking the lead in innovation, to taking the lead in the 5G network, to taking the lead in the development of its own chips. And that's something really, really important, because all of these are future catalyzers for continuously deliver, well, I don't know if double-digit growth, but at least a sustainable growth, but most importantly, more cash to come for this company in the future, and more cash to reward each shareholder through the repurchases. That's something really amazing, and probably that explains why a super investor like Warren Buffett decides to allocate more than 40% of its total portfolio in Berkshire Hathaway to just one company, which is the case of Apple. Has been this company. So really Warren Buffett is committed to this company and not in other companies. So probably because he's seeing this company not as a tech company but as a retail company. So well, you can see now in this video how the drivers are completely different respect to this other big tech company. So if you really have enjoyed this video, please put a like if you consider that this is something that is adding some more information to your investment decision. This is not a financial advice. This is just for educational purposes. Consider to subscribe if you want me to continuously delivering more information about different companies, not only from Apple. And then put a comment if you think that there is something that I should take into account, or probably you want to comment something about the video that you just watched. So I will see you in the next video. Peace.